Thank you, everyone, for coming today. I'm super excited to be here with you. So I get a feel for who's in the audience before I start my talk. Can I ask by raise of hands, how many of you are in academia? Okay, and how many of you are investors or people who want to be investors? And how many of you are part of startup companies who are looking for funding? Okay, so I hope you're looking around the room, all you startup companies who are looking for funding, at all the people who raise their hands as being investors. My name is Joseph Perkins. I'm a partner at Orrick, Harrington & Sutcliffe, which is a law firm based here in the Bay Area, as well as offices throughout the world. It's about a 150-year-old law firm, so we've been around for a while. I've not been there the whole time. I've been there for about 9 years. And my practice is focused exclusively on startup companies, so technology companies. And that ranges from one guy who's got an idea, who's just starting his company, all the way through the company who's done its IPO, and everything in between. So by way of example, I've been on some of the most well-known transactions in Silicon Valley. I assisted Instagram in their sell to Facebook. I assisted Social Finance in their billion-dollar preferred stock financing that closed just last fall. And in the same day, I closed $100,000 financing for another one of my clients. So we really run the gambit of all sorts of transactions. And the point there is that we see things as attorneys from the beginning all the way through the end. And because we see the full range of what happens in the lifespan of a company, we can forecast down the road when we're drafting documents, when we're giving advice, as to what you should be thinking about now to prepare yourself for next year or 2 years from now or 3 years from now. So one of the things that a caveat that I like to give before I start is that 90% of my practice is representing companies. Okay, so I take a little bit of a bent towards founders, towards company representation, and not towards investment representation. I have represented investors. I do it on a regular basis in their financings. But this talk and this presentation is geared towards companies. So that the same advice that I'm giving you now would be the same advice as if you were sitting across the table from me and we were talking about how are you preparing for your financing? What are you thinking about and how do you get ready? Now for the investors out there, I may say things that you might not like, but that's okay. It's important for you to understand what advice is being given to startup companies so that you know how to react, okay? So with that, see if this is not working. There we go. So we're going to talk about the following items. We're going to talk about how to choose your investor. It may sound a little bit presumptuous. It assumes you have more than one person interested in putting money in your company. We hope that's the case. But we also want to talk about how you're filtering out who you're talking to in the first place. Okay? We're going to talk about how to set the stage for your term sheet, how to get ready for it, how to negotiate your term sheet. We're going to talk about some of the key terms in a preferred stock financing. Now, to get through all the terms in a preferred stock financing, we'd probably need about 3 or 4 hours. I'm not going to do that. I'm not trying to put you to sleep. That's what school is for. Processes and getting to close. What happens between the time where you sign the term sheet and the time when the money comes in, and how to minimize that amount of time. And then what to do right now that you have all this great information. All right? So we're going to start with choosing your investor. These are the different topics we're going to talk about. You need to know, first of all, what you need. A lot of times when you're talking about a company, you think about capital. I need money. But there's actually 3 different types of capital that you should be thinking about. Every company needs all 3 types of capital to operate properly. Investors provide generally 1 to 1.5 of those types of capital. First one is human capital. Okay, this is measured in terms of quantity and quality. When we talk about human capital, who is involved with your company right now? Who are the founders? How many founders are there? What is their experience and what is their depth? I can tell you right now, a single founder company is much, much harder to fund than a 4-founder company because of the resources that have already been committed to the company. Okay? The second, social capital, breadth and depth. This can be summarized as a who do you know? What connections do you have within the marketplace? What connections do you have within the industry who can help you help the company grow. Now, this is one of the prime spots where companies coming from Japan into Silicon Valley struggle more than anywhere else. They generally have very strong human capital, people with deep roots, very smart, but they come into a brand new environment, a brand new network that they haven't yet tapped. Okay, so you need to find a way, if you're coming from out of the country into the company, find a way to expand your social capital as soon as you can. Okay, and in the right places. Last, financial capital. This is where most people think of investors, right? They provide money. But it's not just current money that's important, it's also future money. Right? We'll talk a little bit about that. Different investors have different access to current versus future money. Okay? So let's talk about the different types of investors. There's the types of investors that we generally operate with here in Silicon Valley. These are kind of the early stage and seed stage investors. Friends and family, these are, as you would expect, people you know on a non-business basis. Could be a former coworker, could be your brother if you're on good terms with him, could be anyone you know socially. Angels and super angels. These are anyone who's willing to write a check, who doesn't know you through familial or social ties, who's willing to write a check for $10,000, $25,000, all the way through $250,000 to $500,000. It's kind of the general range for the angel super angels. Okay. Incubators and accelerators fall into this range as well. A lot of incubators will provide seed capital, anywhere from $25,000 to $250,000. And then governments and foundations. So depending on what problem you're solving, you may have access to the NIH funds or any other types of governmental funding. Other foundations, if you're working on like a B Corp that is a social enterprise, will oftentimes have access to foundation money as well. And then you get into early/late stage funding. And this is where we get venture capitalists in the picture. And venture capitalists, we'll talk a little bit more about them, but they're typically anywhere from $1 million to $500 million. It's a pretty wide range. Different funds have different strategies, different focuses. They have different market philosophies on why they invest or where they invest. When you're looking at VCs in particular, and also with your angel investors, make sure that you're not just looking at the fund that you want investing in your company. Be looking at the partner who is representing the fund who is investing in your company, right? Because your partner, the VC partner who's advocating for you, he is your intermediary between you and the rest of the fund. He is the one that when you go for your Series B financing, he has to stand up in front of all the other partners and make the pitch on your behalf as to why they should invest more in your company, right? So you want to make sure that, one, you like him or her, that you get along. You know, it's a lot like bringing in another founder, right? You want to make sure the personalities match well. You want to make sure that they're committed to the fund for a long period of time. I've had companies that raise money and then have the partner that was with the fund leave 6 months later. And they were kind of left floundering because no one else in the fund really cares about that company. It was that guy's project and now he's gone. So get an idea for, is this guy here for a long time? Is he going to really advocate for us, or is he kind of on a short-term span? Strategic investors, these are also known as corporate VCs. These are the investment arms of large corporations. They have a very, very different kind of mentality towards their investments. They have different thoughts about why they invest. And we'll talk a little bit more about them as well. Commercial banks as lenders, private equity investment banks, if you're lucky enough to live that long as a company. And then once again, government foundations don't really differentiate between early stage and late stage. It's what status the development of your product is in. Okay? So we can break down what investors typically provide to a company. Typically, investors are bringing financial capital, which seems obvious, but they're also bringing social capital, connections to the network that you're trying to get into. A lot of VCs, especially here in Silicon Valley, are former entrepreneurs. They're former executives at some of the big corporations here in Silicon Valley, and what they bring to you along with the dollar value is, I can get you in front of this company and this company and this company so you can make your pitch. Or I have access to these people who I know are leaving their company right now and we can bring them in as talent to your company, right? Their social capital works to your benefit. With any of these types of investors, you're going to look at a couple different things. For social capital, you look at how broad their network is, how widespread it is, and then within any industry, how deep it is. So the two different facets. With financial capital, you look at how much money they're typically currently able to provide and how deep a pocket they have for giving future capital. And then there's some beautiful notes here. You'll see. So for instance, friends and family generally have no network. That's why they're your friends and family. They also don't have a very deep network. That's not why you're getting money from them. None of those things are relevant for you. They generally have very little capital to contribute, and they usually don't have more after the initial capital to contribute, right? So it's usually first stop, don't come back again. Angels and incubators generally pride themselves on having a very wide network, right? It's very wide, and it gets deep to the extent that they have advisors in the specific area that your company is operating in. But I would still consider that low to medium. And just by way of caveat, I know some of you are out there thinking, wait a minute, I know at least one venture capitalist that you know, doesn't have very wide breadth of social capital, or I know some incubators that have tremendous depth of social capital. These are generalizations, so there will always be people that fall within and without of these buckets, okay? If we start looking at venture capitalists, they're characterized by a high breadth of social capital and medium to high depth of social capital. They generally have deep experience within the industry because partners at venture capital funds tend to specialize in a particular industry, and they wouldn't be talking to you unless your company was also in the industry that they're specializing in, okay? Same thing with financial capital. Venture capitalists have a wide range of amounts of money that they can invest, and they also have deeper pockets for future investments. One of the key characteristics of a venture capitalist is that when they invest $2, $3, $4 million into your company, they're holding back another $10, $20 million in the bank for future financings. They know you're going to run out of money. It's not a surprise to them when you come at the Series B and say, I have no more money, I need more. They expect that. That's part of the process. It forces a conversation between the startup companies and the investors so that they come back together, they realign, figure out where the company is heading, and then make an additional investment and go forward. It's their way of mitigating risk. Instead of giving you the full $20 million, they give you $4 million with an expectation to do another $8 million and another $12 million, something like that, okay? Strategic VCs, this is probably one of the more sensitive topics when you're talking about connections between Japan and the United States, simply because of the high number of corporate VCs that we see in Japan compared to the number of corporate VCs we see in the US, and also the stages at which they invest. At least in my experience, the corporate VCs in Japan tend to invest a little bit earlier than the corporate VCs here in the US. So they have generally not quite as wide a breadth of social capital, but they have very, very deep ties within the industry that they work. They have lots of resources. They have very high current, medium to high current value of financials, and extremely high future financial possibilities. So whenever you're thinking about a corporate VC and raising money from corporate VCs, one of the things to think about is, why are they investing in your company? And there's lots of different reasons why a corporate VC would invest in your company. Surely there's the immediate financial return. You know, companies have to do something with their capital. They have to make it work to be able to report to their stockholders that they are profitable. But the other reason they invest in startup companies is for informational purposes. They can get insights into the market, insights into where technology is going. They have an incentive to invest in startup companies as a way of putting basically an option down to acquire the company in the future. They also have strategic preventative motivations where they can prevent their competitors from acquiring the technology by investing now. And all of these things are good and bad for the startup company, right? Having a great company invest in you means that you have a strong partner, but it also means that none of their competitors are going to be willing to make acquisition bids on you. Because as soon as they make a bid on you, they've given information to their competitor about what their strategic direction is. So you got to take the good with the bad, and whenever you're considering taking money from a strategic investor, just recognize that their incentives are not always purely financial. This is what I call the money matrix. There's smart money, and then there's dumb money, and I don't mean to sound pejorative. And then there's active and passive money. Smart money is money that's coming from people who know what they're doing. They have strong social networks. They're using their social networks to help promote the company. They've been through this process many times before, and they can use it to help the company. Dumb money is more akin to your friends and family. They have no idea what you're doing. They don't really care. They just want to help you out, so they're giving you some money. Okay? Then the active and passive. The active are people who are actively helping you on a regular basis, and passive are people who are just kind of sitting back and waiting for the money to come back. So in the passive column, whether it's smart money or dumb money, you're fine. Okay? Money is good. Money is better than no money. I can promise you that all of my companies will tell you that. The best is active, smart money. People who know what they're doing, people who have been through this process before, who are investing money, who want to work to help you build the company. The worst is active, dumb money. These are people who think they know what they're doing, but really don't know what they're doing, and they spend your time and your resources chasing down leads that aren't going to be profitable. You can take money from any of these people, you just have to recognize who they are. Part of that is a screening process that you're going through when you're talking with investors, asking them, what are your experiences? How many times have you done this? Let me talk to some of the CEOs you currently represent. Go find some of the prior CEOs that they used to represent, they don't represent now. You know, do your diligence on them in the same way that they're doing diligence on you. You need to do that background investigation, if you will, because you're bringing them in essentially as another founder to your company. Okay, opening your doors. This is probably the number one thing I get asked is, how do I find investors? Current network is always your strongest lead. If you have friends who are founders, getting an introduction from them to their investors is one of the strongest leads you can possibly get. You can get service providers like your attorneys, like your accountants, other people that help you. That is a step above a cold call, but not very much higher than a step above a cold call. And then prior coworkers, even if you haven't founded a company with them, if they're off working for another company and they're sitting on the board meetings and they know these other investors, those kind of introductions. You need to reach out 3 to 6 months before you want to raise money. Okay? Investors do not want to invest in a company who they don't know about. And it takes time for them to do the research, time for them to get comfortable with who you are. By way of example, a lot of people look at the Facebook, Instagram merger that happened several years ago and they think, wow, that happened really fast. It came out of nowhere and then they were merged. And yes, it did happen very fast, but the secret is that Mark Zuckerberg and Kevin Systrom knew each other well before the time that they started talking about acquisition. That network was already established, they already had a relationship, and it was an ongoing relationship that just didn't blossom out of nowhere, it took time. So you start thinking about when you want to raise money, give yourself time to start making those relationships, getting in front of investors, telling them what you do, and then starting to set expectations about what you're going to be able to do in the next 3 to 6 months. Then when you meet them again and you say, this is what I've done in the last 2 months, you've been able to demonstrate to them what you're able to accomplish with the resources that you have. You're going to cast a wide net. You're going to meet lots of different people. You need to start filtering through that and deciding which are your most viable contacts. Who's in the right industry? Who has the right background? Who seems most interested in your company and most excited about your company? And then you keep them updated on a regular basis. Okay? Now, no investor is ever going to sign an NDA. Corporate investors might, but the regular VCs, angel investors, they're not going to sign an NDA. If you ask them to sign an NDA, it shows that you are inexperienced and you don't know what you're doing. So don't ask them to. But you should be discreet about what you're disclosing. You should find out if they're investing in a direct competitor of yours. If they are, you should probably back out. You should find out what other people they're talking to, and you disclose things on an incremental basis, step by step. Okay? So before you get a term sheet, the very first thing you need to do is build your product. More than anything else, get a product, get it ready, get it out there. Every once in a while we see companies that seem to be in the business of raising money. Their product seems to languish and kind of flatline, but they're really good at talking with people and setting expectations and getting people to invest in them. Don't be that person. Your number one priority is building a product, because that's what will get good investors invested into you. Okay? Define how you should be measured. What are your metrics? What are the things that are going to determine whether or not you are successful? That's going to change between industry. It's going to change between product lines. Just think really hard, what is the measurement of your success? And last, get your documentation in order. This means working with an attorney, working with your accountants to get everything in order so that when the term sheet hits, you're not going to spend 3 months working with them to try to get your cap table set, right? So you've got your organizational documents. You want to make sure your intellectual property is assigned to the company, your cap table is clean and updated. And if you have a founder who is no longer with the company, who touched your intellectual property, you have to get that resolved before you get funding. Okay? Have to. Investors, if they see that there is a former founder who has left the company, who has not assigned their intellectual property to the company, you will never get invested in. Okay? So a lot of times when a founder leaves a company, whether it's on favorable terms or kind of unfavorable terms, you do everything you can to get them to sign a release of claims. Get a clean separation and each go your own ways. Okay? Investors look for 3 things. Market is a threshold item. You have to be in a market that provides the kind of returns that they look for. Now, this is going to be different for each investor. I had a company that I was introducing to one of the major firms here in Silicon Valley. They looked at him and they said, you know, you're going to be a great company. You're going to be maybe $100 million. You're too small. We can't invest in you. They can only afford, this type of investor can only afford to swing for the billion-dollar fences. But for the angel investors, a $100 million exit is a fine exit. They have different expectations as to what they want to get out of their investment and the timeline that they expect. So market is a threshold item. Product. Is it innovative? Is it simple? Is it scalable? What is the product? What is the technology? What are the barriers to entry? Okay? And the last one is team, both in terms of human capital and social capital. Now, between market, product, and team, like I said, market is a threshold item. If you don't have market, they won't even look at your team and they won't look at the product. Okay? Between product and team, team is the more important. And the reason for that is a great team will take a mediocre product and make it a great product. They'll pivot, they'll change, they'll innovate. A great product in the hands of a mediocre team will get killed. It won't change as the market changes, it won't innovate, it won't move. And so of the two, team is always more important. So be focused on your team as you're starting your company. Make sure you have the right people put together. Ultimately, it's about whether or not you're going to provide the financial return that they need for their fund. Okay? With the caveat, once again, that strategic investors may or may not be investing solely for financial purposes. So your process of getting in front of VC, you're going to have an initial pitch. This is a little bit of a mystery to people that have never done this before. You have an initial pitch. Usually it comes out of a relationship that you have with a single partner at a single venture capital firm or an angel investor, right? You're having coffee. He's like, hey, you're really doing well. I love the way the product is taking off. And you say, hey, would you guys be interested in investing? And you start talking there about what the terms of that investment might look like, okay? When that investor is sufficiently satisfied that you are in a shape that he can credibly present you to the rest of his firm, he will invite you to come present to the rest of the firm, okay? That means that that person will be working with you to help get your deck in order, to help get your financial projections in order so they don't look like fantasy land, right? And then you'll go in front of the whole group, usually the entire partnership, or if it's a larger fund, it'll be the person who invited you plus 3 or 4 other people. And you're pitching them saying, this is our team, this is what we have to present, this is where we're going, and this is our strategy. Once again, when they're looking at you, they're looking at how you think. You're going to have a pitch deck that's probably anywhere from 12 to 20 slides. If you get beyond slide 5, you're probably not doing a very good job. Okay, and the reason for that isn't because your slides are bad or anything like that. It's because your success is going to be measured on whether they are engaged with you in a conversation about the market, about your product, about your team. And as soon as you start and they start asking questions and you have that dialogue with them, the pitch deck goes to the side. You may flip back and forth to say, hey, here's a chart that answers your question. This is a great topic. Let's explore this a little bit more. You're trying to have a dialogue with them to show them how you think. Same thing with your financial statements. No one cares what your financial statements say because everyone knows they're made up. You have no data, especially at a Series Seed round, to be able to say, oh, in 2 years I'll be making $10 million annual revenues. I know. I've done my research. No one believes that. What they do believe is that you have the ability to think about your financial statements. And so when they see your statements, they're going to ask you questions. And what they're doing is probing you on how you think. And that's what they're gauging. How does this person think? Okay?
What's the difference between the initial pitch and full pitch?
The initial pitch is with one person. Full pitch is with everyone. Okay. As you're getting the initial term sheet, do not produce your own term sheet for an equity financing. If you're talking with VCs and equity financing, they will produce the term sheet. A note financing, a lot of times because you're going out to a large number of people who are putting in smaller amounts, it's okay for you to kind of guide that process. But for a VC preferred stock financing, they will produce the term sheet. Okay. Once you get the term sheet, get advice. You will have confidentiality obligations under the term sheet. You can talk to your accountants, you can talk to your attorneys, you can talk to your advisors, broadly defined as people whose advice you value. Talk to your attorney before you talk to your advisors, though. All right? Get feedback on what terms people are seeing in the market so you can make an intelligent decision, right? 2 term sheets are 5 times better than 1. It gives you leverage. It gives you insights into what the market is doing. It gives you insights into how that VC thinks about what is fair compared to what another VC thinks. So if you can time getting term sheets at the same time, that's ideal. I know that sounds a little bit optimistic given how hard it is to get a term sheet. But part of this means is that once it looks like you're going to get a term sheet, you put full thrusters on with everyone else you're talking to see if they can get term sheets at the same time. Yes?
So one thing I've seen recently is actually some exploding offers because investors don't want you to shop around the term sheet.
Yep.
They say, yeah, we're going to give you a week to kind of do this.
Yep.
Actually, in the extreme case I've seen, a friend of mine was actually handed a term sheet that expires in 2 days.
Yes. So most term sheets will have a timeline on it. And a week is more than enough time to get as many other term sheets as you can get, right? There's also, how many investors are here? There's also a tactic that you can use with your attorney. If you're making good faith efforts to move forward with the term sheet that's in front of you, your investor is not likely to go away. Now, if it looks like you're just playing them, they may walk. Okay? But part of that is saying, okay, well, I've given it to my attorney, they're reviewing, and they're going to come back and you're going to talk about what terms are good and what terms are bad. And sometimes, if you were my client and you gave me a term sheet, I would look at a term sheet and I could say, this is a really good term sheet. You should sign it right now. Don't shop around. Don't look around anywhere else. This is fair, and this is like straight down the midway. And I'll see other term sheets where I'll say, you know, I'm thinking something better can come along, or you can get a little bit further with this term sheet than what they have here. And different investors have different tactics on how they present their initial term sheets. Some investors don't like to fool around. They give you their term sheet, and it's kind of a take it or leave it. I don't want to sit here and negotiate for 2 weeks. Okay? So your attorneys, your advisors will have some input on how that operates. Okay? Because most attorneys have dealt with investors repeatedly over time. So I know when I get a term sheet that I have questions about, I have 30 other partners in my firm that I send an email out to and said, hey, have any of you seen term sheets from this investor recently? We're seeing this strange term. Have you guys seen this term before? So you're using the network and the resources that you have available. Okay? I am not going to detail over this because you can read. Big things are looking down the road, making sure that, understanding that what you set as a precedent for your Series A financing gets repeated in your Series B, in your Series C, in your Series D. It's hard to change the terms. Okay? The other thing I would say is second to last one, respecting the process. These people who you're negotiating with are your potential co-founders, quote unquote. You're going to have a working relationship with these people for the next 5 years, right? Don't let the process ruin your relationship, right? So investors can be very aggressive. That's a personality trait common amongst investors. That's fine. Make sure that you're maintaining a good relationship with them as you're going through these negotiations, okay? These are the key terms that you're going to be negotiating about: valuation, control, exit mechanics, and everything else. Everything else, there's a lot of everything else. We're not going to go over everything else. You're going to have 5 main financing documents. You don't need to know this. This is what your attorneys are for. They will help walk you through each of these documents, but everything that goes into the financing will fall within one of these 5 documents. Okay? Valuation. So in early stage companies, before you have data and real metrics that you can rely on to develop a valuation of the company, there is a shorthand that is often used. The question comes, how much money are you raising? How much money do you need to operate for the next 12 to 18 months? Okay? And then you take, what percent of the company does the investor need to own? And what are the comparison points? And the simple outcome of this is you take the target fundraise divided by the target ownership. Okay, it puts you in a range. Okay? The idea being that a company that can effectively utilize $1 million worth of capital is only a $2.5 to $4 million company, right? Because you can only put to use $1 million worth of capital, you must not be that very large of a company. But a company that can utilize $5 million of capital effectively, meaning that it's not just sitting in the bank, they're deploying it, they're building value, they're able to go out to the markets, is a much larger company than a company that can only use $1 million. So there's a tension between you and your investor as you're saying, okay, well, I want to raise enough money, but I don't want to look like I'm greedy. And in reality, the larger the raise, the larger the pre-money valuation you're likely to get. Okay, it's a little bit counterintuitive, and this feature slowly goes away as the rounds get further and further along. So Series D or E company no longer relies on this, right? I can tell you that Social Finance, when they were negotiating their term sheet, did not go through this calculation of saying, oh, $1 billion, we can effectively use $1 billion in 12 months, therefore we are an X size company. It was much more negotiated based on actual financial metrics. But before you have those financial metrics, there's not a whole lot else you can rely on other than what else is in the market and how much money are you raising. Most firms need to own between 20 and 25% of your company after the fundraise is done. Okay, to give you an idea of how that works into the valuation question. Okay, then you're going to come up with the price per share. You're going to take your pre-money valuation and divide it by your capitalization. That gives you a price per share. So we're going to go through this. This is going to be fun. Let's pretend this is our company right now, and we have been able to successfully negotiate a $3 million pre-money valuation with a $7 million pre-money valuation with a $3 million investment. Okay, this conveniently works out to $1 per share. Right? Everyone get the math? So when the money comes in, $3 million at $1 per share, they're going to have 3 million shares. As you would expect, the investors own 3 million shares, 30% of the company. The founders have been diluted down to 60, the employees are at 5%, and the available pool is 5%. Okay? That's the way it works. Now we're going to make it a little bit different. One of the levers we'll talk about here in a second is an increase to the pre-money capitalization through the available pool. So a lot of times investors will come in and they'll say, we want to know that after we invest our money, there's 20% of the shares are available for issuance to employees, or 10% or 15% or whatever number they want to choose, right? This is a circular calculation because in order to find out how many shares you need to increase the pool to, you need to know what the final capitalization is, and vice versa. There's ways that you can do it without circular calculating, but we're not going to go into that math today. Suffice it to say that that same $3 million investment works out to 76, almost 77 cents per share. The investors still own 30% of the company. They're still getting $3 million on a $10 million post-money valuation, right? They still own 30%. But now the founders, instead of owning 60%, now own 46.15% because of this increase to the available pool, which is now at 20%. All the dilution of that increase was borne by the founders and the current employees, not the investors, okay? So the levers. Obviously, pre-money valuation, you're going to be negotiating that. What is the company currently worth? Pre-money capitalization. What numbers go into the capitalization of the company? Certainly outstanding shares would go in, certainly outstanding options and warrants. But what about notes that are converting in the same round? Do the notes that are converting into the Series A financing go into the pre-money or the post-money? And I've seen it go both ways. That's a negotiating point that you'll have with your investors. Note that if it goes into the pre-money capitalization, that effectively lowers the valuation of the company. So long as you're aware of that, then there's no problem. Okay, you just got to know what the levers are. The last lever is the option plan size. As the option plan size increases, the dilution gets higher for the founders, and it's effectively a reduction in the pre-money valuation of the company. So long as you're aware of that, it's fine. Okay? So control is the next big thing, right? You're selling control of the company through selling preferred stock instead of common stock. And the different classes of stock, commons versus preferred, have different ownership rights, right? The preferred class will vote on things separate from the common stock. Okay? The board is controlled through the board of directors, a voting agreement, and what's called protective provisions that apply only to the preferred stock. Okay. So when you talk about board, this is one of the big things you're going to negotiate in your term sheet. A lot of the other things can fall to the side. Board control is key. So one of the things you need to decide is how many board seats will there be? And who gets to decide who designates the board seats? Not just who sits on the board seats, but who decides who sits on the board seats. That is key. Okay? Some restrictions you can place are minimum holding. So if you're an investor, I want you to hold at least X number of shares to be able to decide who sits on the board. If your shareholdings drop below a certain percent because you've sold off the shares, I don't want you to have the ability to designate my board member if you no longer hold shares of the company, right? We want our interests to be aligned, and that only happens if you continue to hold shares. Another one from the investor standpoint is if the founders are no longer providing services to the company, they're no longer employees or consultants to the company, I don't want them determining who's sitting on the board. So you would expect an investor to ask for that as well. The voting agreement means that everyone gets together and says, I will vote for your designee and you vote for my designee. That's the way a voting agreement works. Okay, so we're all agreeing to vote in a certain way. And that binds us together contractually to designate certain peoples to the board of the directors. Lastly, a lot of strategic investors won't ask for a board seat. A lot of times there's a conflict of interest, there's liability issues, and from your perspective, having a strategic investor, a corporate VC on the board presents other problems. For instance, confidentiality issues. If someone comes in for an acquisition, you want to be able to exclude them from the board meeting saying there is a conflict here. So a lot of times corporate VCs or strategic investors will get an observer seat, meaning they can attend the board meetings, they have access to the materials, but you can exclude them and they don't have a vote. Okay. Next, protective provisions. This is a list of things that you cannot do as a company without getting the preferred stockholders' consent. Okay? And there's a couple things you need to think about. One is, what is the threshold of consent that you need to get? Is it just 50% plus one share? Is it 66%? Is it 75%? What is that threshold? And as you look at your cap table, you'll be able to see, if we set it at a certain threshold, who will have the ability to block approvals for these things. So you need to be keenly aware of whose consent you need in order to get approval to take certain actions. These are the ones that are very typical. If an investor asks for these, absolutely, you give it to them. It's in every venture capital financing. You wouldn't blink an eye. These are major changes to the structure of the company, new preferred stock, amending the terms of their preferred stock, agreeing to be acquired, amending the certificate of incorporation. These are all very typical. Some of the not quite as typical, debt, changes in the business, key hires, acquisitions of other companies. We see these occasionally, and they're usually more negotiable. Okay? So focus on the threshold. Watch out for vetoes. Watch out for which single individual has the ability to say, no, no, you can't do an acquisition. You need 75% of the preferred stock to approve this deal, and I own 26% of the preferred stock, so you can't go forward with it. You have to get my permission. So watch out for vetoes. Occasionally what you can get is a carve out to the protected provision. So you could say, we need the consent of the preferred stock to do additional debt unless unanimous board consent is obtained. And because the preferred stockholders are already designating someone to the board, you're saying, as a mechanical issue, we shouldn't have to go out to the stockholders as well. If your board member is approving it, we should be good to go forward. Okay? Note that protected provisions can slow down the management of the company. Part of this is dependent on how responsive your investors are, and you should ask other companies how responsive the investors are. You figure that out ahead of time. And what processes they have to go through in order to get approvals on their end. Okay. The next key issue to negotiate is liquidation preference. Okay. Liquidation preference is what gets paid to the preferred stockholders at a change of control, meaning a merger, an acquisition, an asset sale, other kind of liquidation. Okay. First is a liquidation preference. Okay. They get paid first before anyone else gets paid anything. So in our prior scenario where we had a $3 million investment, if you got acquired for $3 million, all of it would go to the preferred stockholder. Some people like participating preferred, which means once you get your investment back, you get treated like the common stock in addition to your preference. And then there is the cap on participation, meaning that, okay, you can participate with a common until you receive 3x your investment, and then you no longer participate with a common. This is very, very hard to conceptualize reading text, so we're going to use some charts. Okay? We're going to talk about the zone of indifference here in a second. So this is the same cap table that we looked at before, right? 7 million shares of common stock, including the stock plan, treating it all as outstanding, and 3 million shares of Series A preferred stock, for which they paid $1 per share. 1x non-participating preference is the gold standard in Silicon Valley. It means that your investors get their money back before anyone gets anything else. Okay? But then they don't get anything more than that. So we can see here, the blue line is the Series A and the purple line is the common holders. From 0 all the way to the $3 million mark, the Series A is getting everything. The entire liquidation amount. Once it hits $3 million, the Series A stops getting anything and everything goes to the common holders until the common holders are reaching a price per share of $1. At that point in time, the preferred stockholders will make the rational decision to convert all of their preferred stock into common stock. Because by holding shares of common stock, they're going to get what the common stockholders get. Okay, that's how they make their increase. They protect themselves on the downside and get the full upside value. Okay. Now note, between $3 million and $10 million, there is a line, a horizontal line, where the preferred stockholders are not increasing at all in what they're getting. This is called the zone of indifference. For an investor, there is no difference to them of a $3 million exit and a $10 million exit. It's exactly the same to them. So if they have to choose between doing a $4 million deal or risking the sale of the company on a $9 million deal, they're likely to push for the $4 million deal because it cuts their losses and they're able to get out, right? Noting where these points of difference lie is extremely important as you start structuring the company's capital structure. With one layer of preferred stock, it's not quite as difficult. When you get 5 different layers of preferred stock, it looks like a ladder, or all sorts of funky stuff can happen. 4x non-participating. This is the preferred stock getting 4 times their initial investment, right? They get up to $4 per share. Notice now that our threshold for where the common stock starts is $12 million instead of 3. And the zone of indifference goes from 12 million all the way to 40 million. It's a huge zone where the preferred stock just doesn't care what value the company's getting, other than to the extent that it helps them get additional common stock consent to do the deal, right? 1x fully participating means that they get their initial investment first, the 3 million, and then they get treated on a share per share basis exactly like the common stock. These 2 lines will never cross. The preferred stock will never convert into common stock because they're getting paid out the common stock payment on top of their initial payment. Okay, that's participating, fully participating preferred. Lastly is the participating with a cap. You see they're still getting their 3 million initially. They're being treated exactly like the common stock until they hit their 2x cap, meaning they get $2 per share, and then they flatline until the common stock catches up to them, and then they convert. Okay. Knowing how all of these things operate is important, especially as your cap table gets more and more complicated, because minimizing differences in incentives is extremely important in getting deals done. Okay, liquidation, your board of directors must approve all exits. This is a majority of the board. Okay, so that's where board control comes in. It's very important to know what thresholds you need. You generally have protective provisions that restrict how you can exit. You also have statutory provisions that require a majority of stockholders in Delaware to be able to do an exit. There's also what's called the drag-along right, which is the right of current stockholders to force other stockholders to vote in favor of an exit. Now, generally, the 3 things you ask are who gets to drag, who is being drug, is that proper English? And conditions for enforcing the drag along. So who gets to drag is usually a majority of the common, majority of the preferred, and the board. All 3 consents necessary. Who is being dragged would be all stockholders who are party to the voting agreement. And then the conditions for enforcing the drag along are important for, especially for corporate VCs, where they're saying we can't be forced to make representations and warranties in the merger. We will not take on any liability in excess of what we're getting paid out in the merger. So there's different restrictions that just aim at making sure people are being treated fairly if they are being forced to vote in favor of the merger or acquisition. Okay? There is an unwritten control of founders. It is very, very, very hard to do an acquisition if the founders oppose it. If, and only if, they are still with the company. So if you are a founder and there is a deal on the table that your investors want to do, and you do not want to do the deal, even if they had enough votes to do the deal, acquirers are very reticent to do deals where the founding team is not happy. In fact, I would say of the deals I've done, maybe 1 was done against the founder's wishes. Okay, it's an unwritten rule. It's not in any contract. It's just the way acquirers work. They do not want to buy a litigation. And that's what happens when you treat stockholders in a way that people disagree with. It ends up in litigation. Okay? Timing of the deal. So to do a financing, like we said before, 3 to 6 months to get to know your investors. Diligence and investigation, when they start to really dig into your your data and your background, 2 to 4 weeks. At the end of that period, you're going to do your full pitch, hopefully get a term sheet. The term sheet negotiation takes 1 to maybe 2 weeks. Term sheet negotiations typically go very quickly because investors want to get to the finish as soon as possible. And then to draft definitive documents can take 2 to 4 weeks. Okay, sometimes longer, sometimes shorter. That's actually pretty fast. To go from term sheet to closing a deal in just about a month is a pretty good clip. You're going to be busy. Okay? So how to close the deal fast? We said before, organize your documents as cleanly and as fully as you possibly can. Meaning not just that you have documents, but they are actually signed by the people who you think signed them. Right? A lot of times we'll get a company that they say, okay, we got a term sheet ready to go, and we'll say, okay, well give us your documents, and they'll give us a bunch of Word documents. And we're like, well, these are great. Do you have signatures on any of these? Oh no, we'll get them. Okay, can you start that now as soon as possible so we can get to closing, because investors won't close on unsigned documents. You can go through and flag issues that are going to need to be brought up. So some issues you can't resolve right now. You know, I did a financing that closed last Friday where they are being sued for patent infringement. They think erroneously. And we knew this coming into the term sheet. As a matter of good faith, we let the investor know about the litigation before we signed the term sheet. We did not want to get 2 weeks into drafting documents and say, oh, by the way, we have litigation. Sorry, right? Your good faith efforts and is part of that relationship building with your investors. They need to know that they can trust you, and that when something bad happens, you're not going to hide it underneath the carpet. That you're going to be upfront with them and say, hey, something bad happened. This is what we're doing to fix it. Okay, so flagging all those issues and being ready to know how you're going to talk to your investors about them is very important. Focus on the right things. The key business terms that we just talked about and your relationships with your investors. Those are the 2 things that I would focus on during your financing. Let the nitty-gritty stuff, leave it to the attorneys to battle out with their attorneys. Okay, that's why you pay them, so you don't have to deal with it. That your attorney should be flagging for you key points. Right? Here's things that you should be paying attention to. I'll send you all of the changes. You can look at them. If you have questions, let me know. But here are the ones that you need to be aware of, the ones that are actually important. Okay? Respond to questions and inquiries promptly. This goes both from the investor side and your attorney side. So a lot of times there's things that the attorneys can't do unless you give them information. You're producing documents, signed documents hopefully. Respond as quickly as possible. Prepare your board, your stockholders, your note holders, anyone whose signature you need to make sure that they know that you need their signature at least a week before you're getting their signature. So we had this deal where we were raising $230 million for a company, and one of their board members was on a safari in Africa. Literally, like we say that all the time, your director may be on a safari in Africa. He was on a safari in Africa and was completely dark, had no phone, had no access to respond to anything. We were trying to get a board consent out, signed and sent back in order to close in 2 days. And we could not get his response. So we had to wait. And it's because no one reached out and said, hey, board, we're going to be needing your consent next week. Are you around? Very simple, thoughtful thing to do. No one did it, right? Yes?
Electronic signatures like DocuSign or Fine?
Yes, under Delaware law and California. Yep. Yep. And we could have held a meeting, right? You can hold board meetings and then you don't need unanimous consent. But in most bylaws, there's a provision that says you have to wait 48 hours before you give notice to have a valid meeting. So we would have had to give notice and then wait 2 days, which is what we did. And then before the meeting, he actually got online and signed, so we were okay. All right. Just get in front of people. Coordinate your schedules. This goes for the officers as well who need to be signing. Your founders will also need to sign a bunch of documents, and use a checklist to get organized and just understand what the process is that's in front of you. Okay? So here are the things that you can do today as you get ready for your financing. Take inventory, recognize where your weak spots are, whether it's human capital, social capital, whether it's documentation. Just kind of take a full inventory and figure out what you actually need. increase your human capital, social capital as much as possible. Use your network, coming to great events like this, you meet new people, you get to understand what industries they're in, what they're looking for. They may know someone that may be interested in what you're doing. Just expand that out as fast as possible and get the right people into your company. Some founders think that they can do it by themselves. It's very, very rare to have a successful company where someone has carried it wholly on their own shoulders for a long time. Okay? Develop your product. We said before, product is key. Put together your timeline. Understand what your product development and how it's likely to respond to the market. This is not meant to be a static document, right? This is meant to be dynamic and to change and ebb with the ebbs and flows of the market. So you need to explore what happens if the market goes down, what happens if the market goes up, how are we going to adapt to this? Have this conversation because it will be evident to your investors when they're talking to you how well you know your own product, how well you know the market, and what to do if something changes. Okay? Executive summary is like a resume for your company. It's one page. Investors get hundreds and hundreds of executive summaries and business plans, and they will probably spend about as much time as most companies spend on resumes, which is about 35 seconds before they decide whether they're going to read more or less. So it should be, here's the problem, here's our solution, here's why we're different, here's our go-to-market strategy, here's our financials, here's our team and their background. Bullet points, short sentences. Okay? Get your corporate documents in order, and then you'll be ready to go. We have time, I believe, for Q&A.
Thank you so much.
So we have a microphone floating in the back, and we'll just let you float the microphone around. And
We'll work our way from the back.
sounds good.
Hi, my name is Aditya. I have been to a bunch of RX events on related subjects. So 2 questions. One is very short. Can we have the slide deck?
Yes,
Perfect.
we'll have them sent out to you. So for all of those of you who are taking pictures during the presentation, you can immediately delete all of those, and actually wait till the email is sent out, then delete them. Go ahead.
Okay, my major question is, so for the corporate Japanese VCs specifically, how different are their terms compared to typical institutional VCs here in the Valley? And if it's a lot different, what are some of the terms we should be really careful about?
My experience with corporate VCs in Japan is that they are not as sophisticated. I hope I'm not offending anyone. Yes, I've already offended some people. Thank you. Essentially, they don't have as deep of a level of experience as the VCs. I mean, most of the VCs, the partners here, have been doing this for 10, 20 years. And so it's very natural for them to know what to ask for and what to focus on. The corporate VCs are oftentimes advised by local firms in Japan that don't specialize in venture capital. And so they focus on sometimes very peculiar things, at least from our perspective. The biggest difference, I would say, is the amount of time that a corporate VC in Japan takes compared to a VC firm in Silicon Valley. So the diligence process and the approval process for a VC here is very, very quick. You say once they've decided to do something, you're probably talking about a month. A lot of the corporate VCs, you're probably talking 2 to 3 months. And when we meet with corporate VCs, and I have met with many corporations when I go back to Japan, and I talk to them and tell them about the process that happens in Silicon Valley, the number one comment that I get is, "Hayai." It's very fast to be able to go through, do the diligence, get the corporate approvals, get the funding in. A month is not enough time. That having been said, this deal that I closed on Friday was with a Japanese company here in the States, a corporate arm, the VC arm of a corporation in Japan, and I want to say we went from term sheet to closing in 4 weeks. So it does happen. It does happen. I would tell you who it was, but they haven't publicly announced yet. So give it a week. Does that help answer your question?
Partially, yes.
Partially, yes.
Get what will be the difference in the term sheet?
A lot of it will depend on their counsel. The board control, the liquidation preferences will be a little bit different, perhaps. I don't. Part of it is color from the last one that I did on Friday versus the $1 billion one I did in October. They're very vastly different deals. I don't see. Maybe this is a better comparison. Corporate VCs here in the U.S. versus corporate VCs in Japan. I don't see as many commercial tie-ins as a requirement to funding from Japan as I do here in the U.S. So a lot of times you get a corporate VC from the U.S. and they say, okay, we want a partnership agreement, we want some type of co-development agreement, we want something else to tie to. And I haven't actually run into that with the Japanese VCs, which is actually really good. I think that if you're going to do a joint development agreement, it should stand on its own independent of an investment. Okay? Now, that may be controversial, but that's from what I've seen. Tying the two together is not necessarily helpful for either party. Go on to another question. This gentleman here. Oh.
Joe, can you give us some insight into fee schedules for attorneys and accountants? Maybe seed stage, Series A and B?
Extremely high. So a Series A will run you anywhere from a, and this is different between investor side counsel and company side counsel. Company side is usually 1.5 times what the investor side fee is, simply because the investor side counsel is usually saying, go do that, go fix this, I want to see this. And so the company side counsel is kind of scurrying around getting all the documents put in order. We're drafting a lot of the documents. So on a investor side deal, there's usually a fee cap that's paid by the company. And that'll be in the term sheet, right? So once the financing is done, the company will pay the legal fees of the investor not to exceed, in a Series A, usually $25,000. In a Series B, $35,000. Series C, $45,000, somewhere along that range, depending on your industry. I've seen heavily regulated industries like finance or medicine. I've seen fee caps on the investor side up to $100,000, right? Just because there's a lot more digging into the regulatory aspects of the business than is just simply making sure the cap table looks right and the commercial agreements don't have funky provisions. So on the company side, you're probably looking at anywhere from $30,000 to $40,000 on a Series A, if there's not a whole lot of cleanup. On a Series B, you're probably looking at 40 to 50. And that there's a bell curve of attorney's fees where I've done deals that are really, really cheap, and I've done deals that, we get in and find out that the company has signed all sorts of wonderful agreements without consulting us first, and they have to be cleaned up, and a lot more work is involved.
In that spirit, what would the normal seed fees be if you were to get in?
Mm-hmm. So interestingly enough, if you do a convertible note financing, or is often called a safe financing, you don't pay the investor fees, first off, because there's a lot less negotiation, a lot less diligence. Company side fees are usually around $5,000. So it's one of the reasons why if you have to choose between a note financing and a preferred stock financing and you're only raising $500,000, do the note financing, because otherwise you're going to spend, $75,000 on attorney's fees, which, as much as I love the business, I would rather see you grow and be a $1 billion company and pay me off of your $1 billion valuation than have attorney's fees crush the company's prospects. A seed financing, depending on how much investors are going to dig in, you'll probably have investor side fees of around 10 to 15K and around 20 to 25K for the company. If I had to guess, just kind of ballpark. There was a gentleman over here.
Yes,
Oh, there
Joseph.
You go. Yes.
Yes. Great information. Thank you very much. We're actually going through this process now. We're a startup from Japan. We're in the seed phase. We're looking to invest or get investors and raise money. It's directly related to his question. I mean, how much should we budget? Do we approach you for the incorporation documentation? I mean, obviously we want as much legal advice and expertise within the team, but at the same time, we're raising a seed.
Right.
This is the money that we need to invest in human capital, get the company going, and we want as much expert advice as possible. But I mean, when do we start engaging? Is the question.
So the engagement of an attorney is always a delicate issue because we're expensive. Most attorneys in Silicon Valley defer their fees for startup companies, and so that's one way of offsetting the fear of having to talk to an attorney is to say, okay, well, if I believe in you enough that I'm going to do work and may or may not get paid for it, that's a pretty good sign that I believe in your company, right? You want to engage an attorney, but you don't want to have everything done. So for instance, when I get a new company and they say, hey, I'm probably about 3 months away from getting a seed financing, whether that's a convertible note or a seed equity financing, right? I usually say, okay, well, let's get you incorporated because that's very important, and there's tax implications about waiting. Let's get your IP transferred to the company as part of that, hugely important. Let's get you some form documents that you can run off with, and you can contact me, and we can make slight adjustments as necessary. But unless you're dealing with a website that collects information for children under the age of 13, I am not going to do your terms of service and privacy policy. I'm going to say, wait until you have a product that's publicly available before we even take a look at that. It's not much. It's $2,000 to $3,000 for us to look at, but I'm sure you can find a better use for $2,000 to $3,000. I'm just guessing. Trademark is another issue, right? Unless you have a product that's so cool and ready to go out, I am not going to tell you to trademark anything at this point. Because the truth of the matter is that companies will change their names 3 or 4 times before they go to market. Their product names will change 3 or 4 times. And I don't want you spending $5,000 to trademark something that you end up not using. So get further down the line before you start thinking about those things. That having been said, there's risks of not trademarking right now. Right? In my experience, the risk is worth taking. The value that you get out of spending the $5,000 is generally not worth spending it. So you'll sit down and we'll talk about, okay, what's worth doing, what's not worth doing. Let's get the bare bones set up so that when you get to your financing, the attorneys on the other side just go check, 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 done. No red flags, we're ready to move on and get closed. And then after your financing, then we say, okay, well, do you need a terms of use and privacy policy? Do you need to do your trademark? Do you need X, Y, or Z? Make sense? We can do this way and then we'll move up.
Thank you for the great presentation. Very informative. Thank you. So you talked about the IP, and then just right now you talked about trademark. So how is that very common at the very beginning stage of a startup that they have patents that they want to file in the United States, patent applications? Or I think probably more common is trademark, I think.
So patents are an interesting issue because they are much more expensive than trademarks. You can do what's called the provisional patent, which kind of is a placeholder in the patent office. It lasts 1 year before you have to file the full patent. We typically say if you are working on something that is a hard science issue, right, something that's technically difficult, you may think about getting a patent attorney to come in and take a look at just giving you an idea of whether or not it's patentable, whether or not it's something you should start protecting right now, and put a provisional in place that will give you a year to raise funds to pay for the full patent. For most of my companies, if it's a social media company, patentability is kind of, it's not as important as just getting to the market and getting in and getting customers, right? Because most of the products that are out there are either not patentable, and I don't want you to spend $10,000 to find out that they're not, or they might be, but investors aren't going to look at your company and say, oh, you've got a patent, I'm boosting the valuation by $1 million. They don't. a patent is a nice way to say that yes, you have interesting IP, but it's not a guarantee that anything works, that a product is useful, or that it's marketable. There are some up here. Here. We've got a microphone coming. Oh.
Did I pass someone?
Right on your right.
Oh.
Yes.
So the market, product, and then the team are the three elements that you mentioned that what the investors are looking
Yes.
for. And the market is the threshold.
Mhm.
And of the two, the product and the team, you said team is actually the more important element.
Yes.
Could you elaborate a little bit more on that? What exactly, are they looking for?
Sure. So when you're looking for a team, you're looking for someone who, contrary to popular belief, the most successful startup companies in Silicon Valley are not started by 19-year-old college dropouts, notwithstanding Mark Zuckerberg and his teammates. You have exceptions that prove the rule. If you want to place your bets on an entrepreneur, you place your bet on the entrepreneur who has done it before. Even if they've failed before, that's who you place your bet on. So the most successful entrepreneurs are 45-year-olds who have done this 3 times before. Okay? So when you look at your team and you say, okay, what is the ideal team? It's someone who's worked in technology for a long period of time. They've worked in a startup company for a long period of time. They know the space really, really well, and they have a wide social network from which to gather resources. Okay? And the reason that's more important than the product, even though I said focus on your product before you go to your investors, it's true, is because building your team is a long-term project. Most teams come together after people have worked together in a company for 2 or 3 years, after you've been to school together with someone for 2 or 3 years. And when an investor comes in and they look at the team composition, they're saying, okay, well, how has this team functioned in the past? Has this team ever gotten in a fight before? And if the answer is no, they get really worried. At least I get worried. I'd rather have a team that's gotten into an all-out brawl and made up and moved on than a team that's never said a bad word to each other. Because there's going to come a time in a startup's life where things get really stressful and people break. And you want to know where people's breaking points are. So you're investing in the team that's going to take the company forward. You want to know how the team operates. So for instance, as a general rule, is it still recording? All right. As a general rule, I do not take companies that are started by husband-wife founding teams. As a general rule. I have made exceptions in the past, but think about it this way. If your founding team has 3 people and 2 of them are husband and wife, and the third person believes that one of his co-founders is incompetent, who's he going to tell? He can't, right? He's stuck. And if there's a divorce or some other type of breakup, all of that personal interaction gets brought into the company. So in general, it's a bad idea. And I had recently, I brought on a company where there was a founder and his brother-in-law. And that's also a red flag to me. It's like, okay, we've got blood ties here, family ties here. Have you guys ever gotten in a fight before? And they're like, yeah, we fight a lot, actually. I'm like, all right, you can come in. I'm fine with that. You guys know how to fight and be friends? We're good. Right? Similarly, I don't take startups. I try not to take startups that are founded by attorneys for very different reasons. We can talk about that later. All right, we can go on to the next question. Yep.
Okay. I represent Israeli startups, so we fight all the time.
Good.
I'm one of the founders. I'm not Israeli. We have a company that produces wearable technology to keep children safe. It's a GPS watch for children. And then we'll do one for dogs and so on. We started last week raising B round. And one thing that I wanted to ask you is our structure is we have a parent company that is in Cyprus. It's a EU, but it's a tax haven. And then we own a Delaware company here in the U.S. and other operation companies in Israel, in Europe, in all the other places where we're selling the product. Is that an issue? And if it is an issue for a Silicon Valley VC, how do we solve that?
So it may be an issue. And when I say it may be an issue, it may narrow the number of VCs that are interested in your company. So depending on the VC and their structure, some VCs cannot invest in foreign companies. right? Because of who their limited partners are. They have agreements from pension funds that say our money must stay in the United States, period, right? So if your parent company is in Cyprus, I'm assuming that's where the money would generally go to for the investment, right?
Yeah, the IP, the patents are in Cyprus.
Right. So you may run into VCs that say, I can't invest in a Cyprus company. There's also some reluctance to invest in a jurisdiction where they don't know the laws, right? So I'm stepping into a company that I'm going to step on the board of directors for, and I have no idea what my fiduciary duties are in Cyprus. Not a clue. And there's not an attorney. There's one attorney, maybe, in Silicon Valley that could tell me what my fiduciary duties are. That seems like a massive headache, okay? And there's lots of other companies to invest in, so I'm going to say no to you, and I'm going to look at these guys. So what you're doing is you're narrowing the field in which you can fish for investors. The way you solve that is one of two things. You ignore those investors. They're not the right investor for you anyways, because they're not interested in international companies and doing whatever it is you're doing. The other way to do it is to bring that company to the United States. But you're going to have massive tax issues, I presume, in getting the assets over here, the IP and anything else that's over there.
So the way I would do it is to transfer the assets from the Cyprus company to the U.S. Inc. company, or
you could do it in a couple ways. You could, if you wanted to keep the capital structure the same, you'd set up a new U.S. company and then merge the two, with the U.S. company being the surviving parent company, right? And then you'd have a U.S. company with a subsidiary U.S. company with a subsidiary bunch of other companies, and then you could merge these two. A lot of it will be driven by whatever the tax laws are of Cyprus and the tax treaty between the companies. So I probably shouldn't be saying anything more than that because I'm going to get myself in trouble. But without looking further into the tax laws, it's really hard to say what's the cleanest way to go forward. But it is one of the reasons why when we look at Japanese companies, and I represent a handful of Japanese companies, we generally have them, and they usually come over as a KK, and we say, okay, well, what are your plans as a Japanese corporation? And if they say, well, we plan on raising money in the U.S., and we say, okay, stop what you're doing. Let's set up a U.S. company, get the stockholders into the U.S. company, and make the Japanese company a wholly owned subsidiary that's funneling all its IP into the U.S. company. It streamlines things. It makes it easier for U.S. companies to look at you. The question is off the table. If you think about it, you're trying to make the process for the investor as smooth as possible, as few bumps as possible, so that they're going through and they're just checking the boxes and they don't have any question mark boxes to check. And so if you can be a U.S. company, a Delaware company in particular, you're done. If you start saying, okay, well, we are a Japanese company with a U.S. subsidiary, then it's like, okay, now I've got a lot of questions to ask. Now, some investors will specialize in that, and they're okay investing in Japanese companies or Cyprus companies. You just have to go out and find who those investors are, and it's generally a smaller pool.
right? And how long would it take to do this cleanup? Like, for example, to create another parent company, do the merger?
The hard part isn't the cleanup. I could create a company for you tomorrow. It's not hard. You file something with Delaware and you're done. The merger is not really hard. You probably take something off the shelf and be done in a week. The hard part is the research into the tax and the diligence to make sure that we're not screwing something up, that there's not some provision that says, you know, if you do this, there's a 90% penalty tax for taking assets out of Cyprus or something. I have no idea. So it's the research that goes up to that. I would give yourself a month and a half, maybe two.
Thanks.
This gentleman here had a question.
Thank you. Thank you for a great presentation. You said that when we were discussing raising money by steps, that sometimes it makes sense to raise more money and have higher valuation. And I'm at an early stage company, yep. Seed, almost close to Series A. I've raised so far $400K, and I plan to raise about $1 million, $1.5 million before going to a real Series A. But hearing you, would you recommend me to maybe jump directly to Series A? And what would be the prerequisite to raise higher amount? Basically, it's tied to the amount. You know, raising $1 million is not the same as raising.
The last question is probably easier to answer than the first. The last question, the prerequisite is being able to show that you can effectively put to use more money. right? So your business plan has to be put together in a way that when the investor looks at it, they say, okay, yeah, I can see where all these expenses are going, and these investments into the company, you know, you look at every hire that you make, every development decision you make is an investment that the company is making in itself. All these investments make sense and are geared and pointed towards building the company's value, right? If you can show that with a $3 million investment instead of a $2 million investment, it's an easier sell. Now, if they think what you're going to do is invest $2 million in the company and put $1 million in the bank as a rainy day fund in case things don't go right, they don't want that. You know, they can put their money, their $1 million, to use somewhere else actively to build value. Okay. The threshold for whether you do a note financing or a safe financing versus a preferred stock financing is usually around $1.5 to $2 million. If you're raising less than $1.5 million or less than $1 million, do a convertible certificate, a safe, a convertible note. If you're raising more than $1.5 million, I would think about doing an equity round. And the reason being, it's a couple of reasons. These days, you're going to get a conversion cap anyways, right? And we can talk, that's a whole different conversation about what a conversion cap is and how they work, but it's basically a valuation for that specific security, right? Because you're going to get that, if they're willing to do the round at that price, why delay the conversion? Just go straight into equity. If you do delay and you end up with a $30 million valuation and your conversion cap is $5 million, then you have the question of, okay, well, does this security get 6x liquidation on what it's invested in? Because it's getting the same liquidation preference per share as the new securities. Now, there's ways around that, but it makes your cap table a little bit more complicated and a little bit more messy. The other thing is that when you start looking at your Series A investment, your lead investor is going to want to control the round in 90% of the cases, right? Which means they need to invest enough that they own 50% plus one share of the new shares being issued. The more you raise on a note or a convertible equity certificate, the more you have to raise in your Series A in order for that investor to be able to control the round. So if you have a low valuation cap and you raise a bunch of money under that cap and then you wait 3 years and do an equity round, well, that valuation cap is going to result in a high number of shares, and for them to reach that threshold, they're going to have to put in a lot more money, which they may or may not want to do. So it puts pressure on the amount you need to raise. There's also efficiencies of just getting things done and moving forward. If you can get a reasonable investor in, and I know they're all reasonable, but if you get an especially reasonable investor in, where the terms are really clean, it sets a great precedent for your future financings. And so those are some of the things that you would consider.
Thank you for your fruitful presentation. Please allow me to ask a specific area I'm interested in. There are many B2C IT companies in Silicon Valley, and I'd like to know how to evaluate those companies which haven't have enough revenue or profits, like WhatsApp and similar, or Path by Davis Morley and Slack and similar companies. And I mean, maybe customers, you told us, but how to distinguish the value of customers or similar things from the VC's perspective?
Right. That is an interesting and very difficult question. It goes back to determining what your metrics of success are, right? So how you measure the success of your company.
Yeah.
You think about a lot of these companies that don't have a revenue model.
Yes, yes.
And you gave a lot of really good ones. The idea is, can we turn these eyeballs into dollar signs sometime in the future, right? There's certainly no revenue, so you can't use that as your metric. It's not there's not enough data to be able to use that as a valid metric. So you have to use some other metric. For instance, future value of those same number of customers. By way of example, Instagram, when it was sold to Facebook, had no revenues whatsoever. And when they got their $1 billion valuation, everyone thought Facebook was absolutely crazy. Like, what are you doing? paying $1.1 billion for the startup company that has no revenues, has no plan to get revenues, and all they have are people, right? There was a report done last year, I want to say last summer, where a banker went in and evaluated Facebook's business and valued Instagram as about $36 to $37 billion out of Facebook's total business, right? So Facebook did a pretty good deal, right? They paid $1 billion, about $36 billion. It's a pretty good investment, right? And the question is, okay, what did Mark see in Instagram that led him to believe that $1 billion was the right investment amount for Instagram? And what he could see was product market fit with where he was going with his product. And whether that be cross-pollination between the two products and recognizing that eventually my product is going to be on mobile and it's going to use advertising. You know, you have to be able to see not just that there's people involved, because I think that's a great metric, but it's not enough. You have to see where it's going in the market to be able to monetize. And if you don't see a path to monetization, then it's really, really hard to justify a high valuation. So I'm not on the board of Slack or WhatsApp, so I can't tell you what their plans are, and even if I was on board, I couldn't tell you what their plans are for monetization. But if an investor is investing in them, I can almost guarantee you that they've sat down with the company and they will ask, what is your plan to monetize this in the next 5 years? It may not be this year, it may not be 3 years from now, but what's your 5-year plan?
5 years with current business.
With the current business, or what else are you working on that's going to be additive to this where we could monetize it?
Thank you.
My pleasure.
Great. Thank you so much.